Welcome to Investors Guide. This is ET now. Thank you so much for tuning in. Now, it is the beginning of a financial year, which means that you should be making your tax-saving investments right now and not waiting until February or March to do them in a hurry. But what you should also be doing is picking up a pen and a paper and writing down the advice you hear on the show. We'll start off by telling you how the RBI's repo rate cut is going to impact your finances. In our product review, we look at the HDFC Balanced fund and we'll help an investor pick the right asset classes. In order to help me answer all of those questions, Dhirendra Kumar, the CEO of Value Research, joins us on the show. Dhirendra, thank you so much for joining us. A big rate cut from the RBI this week, a repo rate cut of 0.25%, which means home loans will get a lot cheaper. Also, banks are now following the marginal cost of funds lending system, which we will explain in a little bit on the show. But Dhirendra, I want to understand from you, more importantly, what this means for those people who are relying on deposits or relying on debt funds to generate an income. How will the RBI rate cut change their finances?
It simply reduces their income. If you rely on fixed income from your deposits or investment in fixed income because you're a conservative investor, or your need for reliable monthly income from that lump sum investment, then you have no choice but to settle with lower income. So, and the basis of RBI's rate cut is that inflation is coming down. But the inflation number for different individuals could be completely different. If you are in your 60s or late 70s, your healthcare cost could be very different. Yes, you don't spend on transportation. If you have your own house, then of course you don't have much to worry. But if you still are paying rent, then it could be something worrisome. Likewise, the complexion of your expenditure will change in retirement or, as you get older. And I really wonder that, one can save that for those people that their cost actually comes down dramatically. So, yes, those people are in trouble.
What solution would you give them, Dhirendra? Are there any other alternatives at this point? And also, for those people who use debt funds, whether those are short-term debt funds or gilt funds, do you see a spike in their yields given that we are in a lowering interest rate regime?
Yes, that is one way of enhancing your return, but this is a one-time return enhancement. When rates go down, the bond prices go up, but bond prices go up in one shot for a brief period, and so that is why we are seeing very healthy return, healthy past return of all the fixed income categories. In fact, if you look at the liquid fund, they are also yielding about they have yielded about 8.5%. The net effect of a rate cut is that one, you get appreciation of the bond prices, which reflects in the NAV, and that translates into superior return. But soon thereafter, the return on the same bond funds will actually come down and moderate substantially. And investors, I think they need to really prepare for a 25% cut in their income from fixed income securities over the next 1 to 2 years. And that is something which is not very easy to reconcile with. When you invest for the long run and you're investing for a goal which is many, many years away, compared to depending on investment income, primarily fixed income, on an ongoing basis, on a quarterly or a monthly or an annual basis, then this I think is going to be a very steep cut, steep reduction in their income, and investors need to really worry about it. There are few ways of doing it, but there isn't a way around not assuming market risk, and that is something which most old investors may not be prepared for.
All right, so remember, if you rely completely on fixed income investments, whether that's your fixed deposit or any other form of debt investment that generates a regular return, then you will see those interest rates slide over the next months to come. Now, Dhirendra is saying the only option there is to add a little bit of equity to your portfolio. It also helps you beat inflation over the long term. Our debt funds that we recommend for the years on your screen at this point, you can write that down and you can use those. And if you have any more questions about investing in debt or about the interest rates, then get in touch with us. What we are going to do is take you through very quickly what the new MCLR format is and how it affects your home loans.
Up until now, the banks use the base rate system to calculate the rate on their floating home loans. Under this system, the floor rate is the same for all borrowers, however large their business. When the base rate dropped, everyone's rate automatically dropped. The problem with this system was that banks would delay passing on the RBI's rate cuts. The banks say the money they paid on deposits stayed high, which takes longer to reset, while the loan rates would come down. This would impact margins. The MCLR system says that the loan rates will be linked to the deposit rates. So if a bank brings down its deposit rate, it will automatically have to bring down its lending rates. So when banks are keen to reduce deposit rates, they will have to reduce their loan rates.
Quick note of information for our viewers, new PF withdrawal norms. Now, according to these new norms, you cannot withdraw the entire PF amount before the age of 58. If you are unemployed, you can only withdraw your own contribution and the interest on it, but your employer's contribution stays locked in till the age of 58. Those norms have now been postponed till the 1st of May 2016. So if you want to withdraw your PF, you can actually do it in this 1 month, because starting the 1st of May, you will no longer be allowed to withdraw any of that money. Dhirendra, let's move on now to our portfolio question. The 34-year-old Rahul has written in, Dhirendra. He tells us he's an NRI living in the UK and he wants to save enough to buy another home by 2020. He also wants to save for his child's future, for an education and for a wedding. He wants to be able to build a corpus of 4 crore rupees by 2045. He sent us his financial details and he tells us that right now he has no dependents. His wife has her own portfolio and is not dependent on his money in any way. He saves about 1 lakh rupees every month. He has 4 lakh rupees in an emergency fund. He has a home loan, a post office PPF account. I'm wondering why he needs that. And a post office fixed deposit. He tells us he owns some real estate. There's a home under construction and a plot of land. And he has the Pradhan Mantri Suraksha Bima Yojana. Again, I'm wondering why he has to have that under an LIC policy as well. He sent us a list of mutual funds that he's holding. Dhirendra, for an NRI, it's a very confusing portfolio that he's put together. Some of those things don't even suit the kind of numbers we're talking about when it comes to his portfolio, do they?
One is that for an NRI who is able to save 1 lakh rupee, lives in UK, he has to really look at objectively his health insurance need. Of course, being in UK is a great privilege. Every citizen there, every resident there does not have to worry about the health insurance as much. They're well covered. So he should worry about the term cover and having an adequate one. And after that, he should really worry about building his physical assets here. Building a house or owning real estate in India to derive rental income with a remote supervision or management, that could be quite taxing. And for somebody who is 30-year-old, I would like to have a very simple portfolio. Besides term insurance, he should have a substantially large emergency fund. Maybe consolidate all his investments into an emergency fund and just do his equity investment. For somebody who is 30-year-old, for next 20 years, he can accumulate his savings into equity and he will have all his goals and much more than that, because I don't know if 4 crore will be enough 30 years from now.
It's very simple advice. When it comes to buying property, particularly what Dhirendra is telling you is to remember, especially as an NRI, there is a lot of management that needs to be done when you buy a real estate asset. You have to visit really often. Right now, a lot of the projects across the country are getting delayed, so it might require far more attention than just putting money in something and just waiting for it to grow on its own. So even after and even when that project or that property is delivered to you, you'll have to visit, you'll have to rent it out, you'll have to pay maintenance, you'll have to pay property tax. There's a lot of work that needs to get done. So keep all of that in mind if you're going to invest in property. Dhirendra, let's take a look at the mutual funds. Well, the ICICI Prudential Ultra Short-Term Fund is one of the funds he has, Reliance Retirement Fund and the ICICI Nifty Index Fund, Dhirendra. Again, they don't seem to be in any way connected to the goals he wrote about a little while ago. Do you think that he should continue these investments at all?
No, I think he should discontinue all his investment and just get hooked to our aggressive growth portfolio or our growth portfolio. And if he is investing 1 lakh of rupees a month, consolidating all his current investment into an emergency fund, liquidating them as and when he is able to, he will be much better off, and that should be his only. And he can well take one of our aggressive or aggressive portfolio or growth portfolio, without the fixed income allocation if he's going to have an outsized, much larger emergency fund, because that will be his fixed income allocation. And that emergency fund can, partially be in cash lying in his locker. A part of it should be in his deposit, should be a deposit, and a good part of it can well be a debt fund, could be a short-term debt fund.
So our aggressive portfolio is on your screen right now. So here's the thing, if you're a 30-year-old, whether you're an NRI or you're in India, and you have such ambitious goals for your own retirement and for your child's future, you have to be investing in aggressive equity. Putting your money in a PPF or a fixed deposit or a debt fund is not going to get you there in any way. That instrument is just not fast enough, and it doesn't have the stamina to keep up for the 20-year horizon that you have. The only instrument that will keep up is an equity mutual fund that's on your screen right now. Write down the names of those funds. If you have any more questions, get back in touch with us. After the break, Dhirendra will stay with us. We'll talk about HDFC Balanced. We'll take a look at that performance and find out if you should stay invested. Don't go anywhere. Welcome back. You're watching Investor's Guide on ET Now. Thank you for staying with us. It's time for our product review. And this week we're looking at the very interesting HDFC Balanced Fund. Avan will give you the latest numbers and then we'll come back and talk about it. Avan.
Thanks, Faye. This week we take a look at an aggressive balanced fund, the HDFC Balanced Fund. Backed by a strong fund management, this is one of the most impressive balanced mutual funds. While its performance over the long term has been outstanding, how does its performance look in the short term? Let's take a look at the performance chart over the last 5 years. You'll see that the fund has performed well in both the bull and the bear phases of the market. The fund has consistently outperformed its benchmark and its category over the last 5 years. Its performance was particularly impressive in the year 2014, giving a return of 51%, way above its benchmark and category. The fund's performance might have dropped the following year, but you'll see that it still manages to perform better than most of its peers. The fund balances equity and debt securities very well, making it one of the best balanced funds in its category. Is this a must-have fund in your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that information. Dhirendra, the performance over the last 1 year of this fund has been close to 3%, but its return since launch of about 6.5% will still give a lot of balanced fund investors a certain sense of comfort. It's 4 stars on value research. Where would you, what is your review right now? Do you recommend our balanced fund investors use this fund?
Yes, absolutely. It's a very desirable balanced fund. It is a dependable balanced fund. And this is it has all the variables, nicely in place. And if you look at the dissection, if you look at the components of our rating, this is what I look forward to, at least in a balanced fund. A balanced fund should be should be moderate on volatility, because investors, particularly investors investing in balanced fund, they don't have the appetite for big ups and downs. And this fund has particularly demonstrated it, and it follows a reasonably conservative, a multi-cap and large-cap tilted equity portfolio. It doesn't take a big bet. It has followed its allocation or rebalancing principles nicely, and it has been a large-cap growth portfolio on the equity front, and the fixed income component is a reasonably high yielding. So it is a very high quality balanced fund. One should consider this one.
All right, Dhirendra, what is your star rating for this fund for the viewers of Investor's Guide?
Incidentally, what we find on our, many investors will be getting confused, because right now HDFC Balanced Fund, the direct plan gets a 5-star rating, and the regular plan is a 4-star rating, and the difference is primarily on account of marginally higher return, marginally higher expense. Which slots it, where the regular plan gets lowered on the rating scale. But going by, what this fund does and the number of options available, I would slot this fund as a 5-star fund.
All right, 5 stars there for the HDFC Balanced Fund on Investor's Guide. Remember, Dhirendra said it's a sturdy, stable, large cap focused balanced fund. So if you're looking for a fund that gives you exposure to equity but not the seesawing of a choppy market, will sort of cushion you from that sort of seesawing, then this is a fund for you to be using. Let's move on to our hold or sell segment. 30-year-old Venkatesh has written in. He sent us a list of the mutual funds that he wants to invest in for the long term, Dhirendra, and he wants to add one more fund to this list, and he wants to know if this is the right route to go. He's 30 years old, so I'm assuming it's a long-term investment. Birla Sun Life Frontline Equity, 1,000 rupees a month. Go ahead with this investment.
Yes, it's absolutely the kind of fund which somebody should be investing regularly for a few years.
He also has the DSP BlackRock Microcap Fund, Dhirendra, and he put 30,000 rupees into this fund as a lump sum investment. That I know is not going to make you happy. What would you recommend he does with this investment?
If one is comfortable with the big ups and downs, and if one has more than 5 years, 7 years, 8-year time frame, and one can continue investing regularly in such a fund in the worst of times, which is not a very easy thing. It is much easier said than done. When you see your investments go down in value by 60-70% and you still continue to invest, is not an easy thing. But if you are prepared for that, this can give you outsized return.
The Reliance Top 200 Fund is also on his list, Dhirendra. He's investing 500 rupees a month along with UTI Equity with another 500 rupees a month. Continue both of those investments?
Reliance Top 200 is a fairly average fund, and UTI Equity has turned out to be a good fund and continues to remain one despite the fund manager's exit.
All right, so there you have it, Dhirendra, giving you, his review of your portfolio. If you have any more questions for us, get back in touch with us. Our email ID is at the bottom of your screen. We've run out of time on this segment. Dhirendra, thank you so much for joining us.
Thank you.
If you're watching at home and you'd like to ask us a question, feel free to get in touch. Our email ID is at the bottom of your screen. Dhirendra, thank you so much for spending time with us this week. We're going to take a quick break. We'll come back and talk more about your investments on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. We're going to answer some of your questions on asset allocation with Karthik Zaveri. Our first question comes in from Prabhu, who tells us he'll be opting for voluntary retirement at the age of 58, which I'm assuming is soon. He tells us he has about 25 lakh rupees in mutual funds and bonds. He has some exposure to a group of shares, although he hasn't told us the names. He wants us to suggest a couple of funds he can begin investing in for the long term. He doesn't need a monthly income because he'll already have a pension. So this is a great idea, Karthik, because using mutual funds for the long term will help him beat inflation. If he's retiring at 58, for the next 20 years, his corpus is going to have to grow larger than inflation. What would you recommend for him?
I would suggest that you consider putting about a third of your assets into large cap kind of funds, about 35 to 40% of this money into mid cap funds, and another about 30% into sectoral funds. Now, I would suggest you to do two very interesting things while you make this asset allocation strategy. One of the things that we must do is we must try and go to about 2 different schemes in each of these categories. So to say, we need 2 large cap schemes, we need 2 mid cap, and we need 2 sectors to look at. Now, while we do that, we also want to distribute the risk of our investment with various fund management teams. So therefore, each of these 6 products that you will buy will ideally should be from a different mutual fund scheme or a different mutual fund company. So which is to say that you could look at a pharmaceutical fund in a sector allocation, you could look at another logistics or an infrastructure fund. You can also consider banking as an interesting area which is likely to grow for many years to come. So you could probably choose 2 of these sectors from different fund houses, of course. You have a large plethora of mid-cap schemes which have been doing exceedingly well, even in a situation where the markets are not as good as they should be and they are, in a depressed state of sorts. You still have a lot of mid-cap funds which have shown great promise and consistency over the last couple of years. Maybe you can consider them. And in terms of large cap, again, we need to look at 2 large cap. You could also look at multi-cap funds to fulfill this particular requirement of yours. And that's how you should distribute and create your portfolio.
Our next question comes in from Karunesh Singh. He has a lump sum of 40 lakh rupees to invest. He tells us that's in his savings bank account right now. Don't leave money in your bank account. it sort of lose its value because it's not even beating inflation. He wants to know how he can invest for the next 10 to 15 years. Is there a list of equity funds that we can give him? Should he be staggering his investments? You should definitely be staggering your investments, Karthik, and he should definitely be using equity.
Number one, about the method of investing. Now, the method of investing is obviously a good idea to stagger the investment, which is to say that whatever money you have, why not sort of just break it into a couple of parts and then invest it. What is happening as a result of this is we are going to take the average rupee cost averaging formula advantage, which means to say that just like an SIP where we are doing a monthly investment, when you have a lump sum kind of a money to invest, at that stage we break that money into smaller parts to invest in the equity market. So we start by going into a liquid fund and we then do what is known as a systematic transfer plan. We break that money between 6 to 12 installments, and in 6 to 12 months, so to say, we will deploy the money into the equity market. So what happens here is it's only a deployment strategy, wherein if the market actually corrected at 10 or 15% or 20% at some point in time, and had we invested the entire money, then psychologically we would feel quite bad that we've lost money or we are in the red for the time being. But obviously you want to hold for a much longer period of time, so and therefore in that longer period of time everything would get even out and you would also make great profits in times to come. A fund that might look really nice at this point in time need not necessarily be a fund which is also great 5 years or 10 years down the line. So which is why again one needs to go back to the monitoring and go back to the research desk and continuously keep witnessing the performance of these funds. Many factors affect the production and the performance of a fund. These could be things like the fund manager's decisions. It also could be the market. It could be the external environment. It could be the interest rates. It could be the kind of stocks that are held into these funds, which are affected by certain governmental policies. There's a whole variety of reasons why a stock performance could be affected or adversely affected. So which is why again monitoring is something that you cannot eliminate and you need to keep watching it. What you don't want to do is constantly churn it, or every time there's a 5 or 10% profit, you don't want to really book profits and move out, and because then you will be hit with exit loads and capital gain tax. You don't want to do that. Yes, you want to invest for the long term, but keep a very close watch.
All right, and on your screen right now are our aggressive mutual funds that have been recommended on this show. So if you have your time horizon and you want to make a lot of money and you're willing to take that risk, these are the funds that you should be using. Last question comes in from Radha Singh. He has 40 lakh rupees in bank deposits making about 8.4% interest. He wants to know if he should close those deposits and put the money in mutual funds instead because rates are decreasing. He wants to know if there's any way he can make a return of 15% over the next 5 years. Well, in my opinion, equity would be the only way to do that. But remember that 15% is not guaranteed. Karthik, what would you recommend?
Equities will definitely give you a 15% plus rate of return, but it has a certain amount of rules that you need to follow. Prima facie, the rule being that when you invest in the equity markets, you need to consider that your investment time frame is going to be definitely in the range of 5 to 10 years at the minimum. If you're going to do SIPs, it's going to be 10 to 15 years. If you're going to do a lump sum investment today and then do an STP route and then slowly move that money, you're still looking at a bare minimum of 5 to 7 years. You could be really lucky and 2 years the equity markets could rally and you could make a lot of profit, but that's obviously not the ultimate objective because you want multiplier in terms of wealth creation. So you will get your returns, but you need to really determine whether you are on the wealth creation side of your life or whether you're on the protection side of your life. If you have adequate assets and if you don't need the volatility in your life, then think about fixed interest investments like tax-free bonds and like your fixed deposits. If you are on the mode where you need to create wealth, where there is a pronounced reason to create wealth, then think about equity investments.
All right, that's a wrap on this episode of Investor's Guide. Now, remember, you can always write to us with your questions. Our email ID is at the bottom of your screen. Anything you want to ask us about your money, feel free to get in touch. Tune in next week to catch Investor's Guide. Thanks for watching.